And it is getting used to that notion that trends persist and they go far, far longer than you will ever imagine they will go. We all have this notion of we think what something is worth. I keep a series of charts here on my desk that I look at to remind me that I have no idea how far something will go. And charts will go, price will go much further than you could ever imagine. Think of it this way. Think of an example. Think of Enron, one of the greatest scams of all time. Nobody imagined that when Enron began to collapse that it would go to zero. But it did. It went far further than people could ever imagine. It didn't stop Wall Street recommending it all the way down as it crashed and burned into the ground. But it still went far further than you can imagine. The reciprocal Facebook. When Facebook listed, people were going, Facebook's dead, young people just don't use it, it's rubbish. Look at the price now. Prices move far further than you could ever imagine. And so it's convincing yourself of that. You convince yourself of it by seeing it in repetition. And a good data set is the S&P 500. It's small enough to view just by flicking through it once a week. It's also of a reasonable size. Once you get a sense of what you're seeing, to go, well, I've seen that when price moves X amount above the moving average, the trend seems to persist. Okay, I can write that down. If I can write that down, I can probably code that. Okay, I can code that. Let's run it and see what we see. And it is that start simple with simple in mind.
Mm-hmm. And I think convincing yourself of that is good for two things. So first of all, if you know that trends are going to persist more than you think, then you're not inclined to keep a trade that's losing longer, because you might be losing even more. And at the same time, you're more likely to let your profit run, which is a good thing also.
And the thing you mentioned first is the really key statement. It is accepting that when it's gone wrong, it's gone wrong.
Yeah.
And it going wrong is not personal. The market's not launching a personal attack on you saying, you're a peanut, why did you buy that? It's simply a function of the way price acts. It's a little bit like, if I head down the beach to go surfing, there are days when the waves are rubbish. You sit out there and you go, I'm shark bait and freezing. There are days when the waves are brilliant. There are days when the waves are brilliant and one of them smashes you into the ground. One that smashes you in the ground is not doing it personally. It just is a function of the way it is. And losing trades are simply a function of trading. It's not a personal attack. It's not a reflection of your ego. They're not telling you you're stupid. But you need to understand there's no nexus between being right and making money. If your payoffs are high enough on average over time, you can have a trading system that's right 30% of the time and still make a great deal of money. In fact, that's how most trend-following trading systems work. They have a hit rate that is below random, but their payoff when they win is so high because they just hold the winners. And they don't, as you say, let the losers kill them.
That's a great point. That's awesome. Now, I know some people, if they were to do this, to kind of look at a chart, and like a weekly chart for some time, they might get bored, or they might feel like things aren't moving fast enough, and then they might stop and go back to trading and just getting straight quickly.
Yeah, and that's an excellent point, and that is a perennial problem. And I have to confess self-interest here in that I trade systems at both ends of the spectrum. I trade a short-term 4-hourly system over a very narrow universe, which is used to generate cash flow. That's all it does. The wealth creation occurs via long-term equities because they're the only things I've come across that can generate that level of wealth over a period of time, where you have a stock that goes up not from $1 to $2, but from $1 to 10 to 15 to 20. And it gives you all these opportunities as it goes along the pyramid into it and to actually buy more. When you're trading shorter term systems, and what you say is a really good point, because the majority of traders trade for entertainment. They don't trade to be profitable. Is that you've got to delineate wealth creation from cash flow. But what happens is most people go, I'm trading for cash flow, therefore I'll trade short term. that's not the reason they're trading short term. They're trading to be entertained. And if you can get that notion that the market's a casino out of your head, then you can actually do both. You can have one that pays the bills and keeps the lights on, and one that acts as a wealth creation device. And that they can exist. They can coexist in harmony together. And I think for some traders, what happens is that one takes the pressure off the other. So that if they do have a small amount of their portfolio that they trade for cash flow, they're not tempted to begin to disturb or disrupt the long-term system, which is actually generating real wealth. But it's getting over that notion that it's not for entertainment. It's a business, nor is it a hobby. Hobbies are meant to be pleasurable. There are times when trading is really not pleasurable, and it's a really expensive hobby for people who get it wrong. So it's we come back to that thing. It's work. You have to work.